Good afternoon. Today's been a pretty good day compared to yesterday, where it just seemed like no matter where I went or what I did, there was someone there that was just taking their time, and I really didn't have a lot of extra time to spare, so I kind of ended up not doing a couple of things I wanted to do. Anyway, my name is Debbie. This is Cleo. This is one of my rescues. She likes to be held. So today I have her with me on my lap. And as I said, today has been kind of a busy day. And so it's also a Starbucks day because I really had a lot to do. And now I'm home, which is kind of nice. But one of the things that I did this morning was go to the meeting at my office. And I got this magazine, which has a really interesting tax-related article in it. And I read it over a few minutes ago, and because the title of it attracted me, it's called The Ins and Outs of Tax Reform. And since I'm a tax preparer and also a real estate agent soon, because I'm waiting for my fingerprints to clear, but that's a whole nother story. These two items kind of go together and kind of intrigue me, and so I was attracted to this. Now, I've been looking for the author because I wanted to credit the person, but it's not in here. But it does say this: love it or hate it, tax reform is now law. So this is to be able to check out some of the major provisions, especially as to how they might impact your real estate. So one of the first thing that's listed is regarding mortgage interest deductions. Beginning January 1, 2018, a new cap for mortgage interest deduction is $750,000, which is down from $1 million. Home equity loans, the interest paid on those can only be deducted if the proceeds are used to substantially improve the residence. So I'm safe there again. State and local property taxes. California residents now have a $10,000 combined cap on all of their state and local tax deductions. Good old California. Casualty losses. The Tax Cuts and Jobs Act allows casualty losses to be deducted only in a presidentially declared disaster. Oh, here comes JR. He might get in the picture here a minute. He's another rescue, but he's an oldie moldy. He's a kitty. Okay, moving expenses. This is new. Moving expenses are deductible only for members of the armed forces, which is not necessarily a bad thing, but apparently then moving expenses for if you're moving because you have a new job and you have to move closer to where the job is, then that used to be deductible. So I'm going to have to research that and make sure that I'm understanding this correctly. But it sounds to me like unless you're in the military, you're not going to get those deductions. Tax bracket changes. There will continue to be 7 tax brackets, but the marginal tax rates in each bracket will be slightly lower. And here's a couple of things that, in my mind, they kind of offset each other. The standard deduction will nearly double in 2018 for $12,000 for individuals and $24,000 for joint filers. But then your personal exemption, which was $4,150, you're not going to be able to take. So I have to look at where those things fall on the tax form, whether they're considered above the line or below the line. But again, something that I need to clarify for myself before I can answer your questions. So stay tuned. Let's see, qualified business expenses, and this is good for real estate licensees and anybody who runs their own business. You can deduct qualified business income. Provision allows an off-the-top, above-the-line deduction of 20% of business income subject to certain provisions. And there are caps on those too. Limitation of $157,000 $1,500 for a single taxpayer and $315,000 for joint filers. Ugh, Cleo. Okay. Section 179 expensing, which is the depreciation. The amount of qualified property eligible for immediate expensing increased from 500,000 to 1 million. Phase out limitations are increased from 2 to 2.5 million. The definition of qualified real property eligible for Section 179 expensing has been expanded to include any of the following improvements to non-residential real property placed in service after the date such property was first placed in service: roofs, heating, ventilation, and air conditioning property, fire protection and alarm systems, and security systems. So it sounds to me like non-residential real estate, business property, you'd be able to expense those things. Entertainment expenses, no deduction is allowed with respect to an activity generally considered to be entertainment, amusement, or recreation. Membership dues with respect to any club organized for business, pleasure, recreation, or other social purpose. And again, I need some clarification on that and verification that means that you wouldn't be able to, say, for example, deduct your dues in the Chamber of Commerce. Generally considered to be entertainment, amusement, or recreation. So any business affiliation, I would hope. But then again, in the next line, it says membership dues with respect to any club organized for business, pleasure, recreation, or other social purpose. And this is where sometimes when you read articles like this, you have to actually go and dig into the regulation and try to figure out exactly what it is they're trying to say. Because to me, I don't know if this means all three of these bullets. It probably does, but then again, I like to have clarification. Anyway, taxpayers may still generally deduct 50% of the food and beverage expenses associated with operating their trade or business. For example, meals consumed by employees on work travel. And one last thing here, which only applies to certain ones, rental income. Who have rental income. The 20% qualified business income deduction applies to rental income since the changes that produced the wage and capital exception were intended to apply to rental income. However, what exactly constitutes a qualified trade or business is not well defined by tax law. Welcome to my world. There are a number of different interpretations for different purposes of the tax code. Typically, to qualify as a business, the activity must be regular, continuous, and substantial. And I think for real estate agents, that definitely qualifies. For people who manage property, I definitely think that qualifies. Regular, continuous, and what's the other word? Substantial. So, there is a television news cast that's coming up that's going to be talking about some of the red flags that the IRS looks for and to audit. So I'll be interested in watching that, and I'll report back to you on what that is very soon. Have a great rest of your day, or not. I hate being told that sometimes. I know that's just me. If you would like for me to do your taxes, which I will do at a very nominal fee, I only charge $50 to help you file online. If you're under a certain amount, you can do it for free. If you need to have some questions answered, I'm right there to help you, or I can do your taxes for you. I pick up and deliver. You can leave a note in the comments. You can contact my Facebook page, Freestyle Tax, under Debbie Freeze. That's one of my managed pages. So, or you can call me, 707-694-8925, or text me. All right, so take care and love y'all, and see you next time.